and Associates, and we are very pleased to have Sarah Watthouse from Wells Fargo with us. Those of you that have signed on, if you could type in the your comment section if you can hear me. I just want to make sure that everyone can hear and can see Sarah's screen.
The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, James Kemper with WH Meaner & Associates. We are very pleased to have Sarah Watthouse from Wells Fargo Securities with us this afternoon. Before we kick everything off, if you could type into the comment section that you're able to see Sarah's screen and can hear me. Just want to make sure that everything is working appropriately. Let's see. Now we've got some more people that are joining, so we will give a couple of minutes, but if you could certainly sure that. Okay, great. Can hear and see. Thank you, William. Anything else? All right, well, with that, we will get started. We're really pleased to mention that we have Sarah Watthouse, and she is Vice President and Economist for Wells Fargo Securities, Wells Fargo Company, based here in Charlotte, North Carolina. Now, Sarah covers the U.S. macroeconomy, including the labor market, manufacturing sector, and inflation trends. She regularly writes indicator reports, produces special commentary, and contributes to the company's weekly economic and financial commentary. Sarah frequently speaks about the economy to the national media, including Bloomberg News and National Public Radio, good old NPR. Prior to joining Wells Fargo in 2010, Sarah worked as a research associate for the Federal Reserve Bank of Richmond. She earned her BA in economics from Tulane University in New Orleans and an MSc in local economic development from the London School of Economics. She is a member of the National Association of Business Economics and the Charlotte Economics Club. So give me, everyone, a warm welcome to Sarah Watthouse. Sarah?
Thanks, James. Well, good afternoon, everyone, and thanks for joining the call. So today I'm going to go over the outlook for U.S. growth for the remainder of the year and into 2016, and also talk a little bit about what's happening in the global economy, particularly because that's having a lot of impact on what's going on back here in the U.S. So just to give you an idea of some of the big themes that we'll be going through, I won't go through all of these, but generally the domestic economy is doing pretty well right now. It's not nearly what we were used to in prior expansions in terms of the rate of growth. But when you look around, the fundamentals are fairly strong. We don't have a lot of pockets of concern that make us think that a recession is imminent or anything like that. But if you look at what are some of the issues and risks out there that we are worried about, a lot of them are coming from more global factors, particularly the drop in oil has been a big hit to our investment sector, and a lot of that's due to the global oil market, as well as just kind of general overseas growth right now and what that's doing to the outlook for monetary policies in different parts of the world, including the U.S., and how that's impacting the dollar. So looking at just the overall forecast for GDP growth, so we actually got Q2 out this morning, and it showed that growth in the first half of the year was actually a bit stronger than what we initially thought it would be. So we saw GDP in the second quarter increase to 2.3% annualized rate, and that contraction that you're seeing in the first quarter of this year actually got revised up a little bit. So the economy didn't actually shrink in Q1. We saw a slight increase at about a 0.6% annualized rate. So Well, this is disappointing compared to the rates of growth we grew accustomed to in previous expansions. We think that this is actually pretty strong numbers when you look at potential growth. And what we look at when analyzing potential growth is you can really kind of approximate it looking at growth in labor force participation in the working age population, as well as productivity gains. And both of those have been fairly weak in recent years, and so relative to potential, the U.S. economy is actually doing pretty well right now. See a further acceleration in the second half of this year and growth of about 3% in 2016. So really where a lot of the weakness has been recently, though, has been concentrated in the manufacturing sector, which I'm sure is no surprise to this group or not anything new. But it's interesting when you look at the ISM manufacturing and non-manufacturing indices. So these are based on purchasing managers just generally saying if business has picked up over the past month relative to the previous month. And you can see the big deceleration in the manufacturing sector since the second half of last year. But I think what's really interesting is the divergence between manufacturing and non-manufacturing. So you can see that the services side of the economy is actually still doing pretty well. It has decelerated not expanding at quite as rapid pace, but still fairly strong, and that's about 85% of output in the U.S. economy. Now, of course, that manufacturing weakness, that's where this kind of global story comes in. So part of it has been concentrated in areas of manufacturing that rely heavily on the oil and energy investment boom that we've been seeing over the past few years. But of course, the dollar has been a big headwind. We've seen that rise about 15% over the past year, and we actually think it has further to appreciate over the rest of the year. We're looking for about another 2.5% and further appreciation in 2016 of about 4%. So even though some of the weakness in the early part of the year was chalked up to transitory factors, we think that some of the drags are going to be here for a while, and so that's going to temper the pace of growth that we see over the remainder of the year and into 2016. So with the stronger dollar and also some strengthening here at home, we have seen a widening of the trade. So net exports are going to be a pretty persistent drag over the remainder of the year and into next year. Partly coming from the fact that the U.S. consumer position is strengthening a lot. I'll talk about that a little bit more in the next few minutes. But also from the fact that global growth does remain rather sluggish, and so you're not getting a big bounce from exports there, and then you topple that on with the stronger dollar. And so this is certainly one area of drag on the economy that we haven't really had to deal with as much in recent years. So when we look around the world, what we're seeing in Europe is we are seeing a cyclical upswing. Not robust by any means. We're still looking for growth somewhere just around 1.5% in the Eurozone this year, and maybe closer to 2% next year. But there are a lot of positive things going on in the Eurozone if you just ignore the July headlines with all the Greece issues. But they are also benefiting from cheaper energy, particularly as production has been a part of their growth story the past few years. But also importantly, we're seeing a resurgence in bank lending there. So it's up about 1.5% over the past year, which isn't a lot, but compared to the fact that it was contracting between 2012 and 2014, that does represent some positive signs on the horizon. And of course, you've seen the euro depreciate against a lot of its major trading partners, so that's helping there as well. Now, China, of course, is the other big story that's going on in the global economy. So we have seen growth slow there, and we're only looking for growth of about 6.5% this year. So that would be the slowest rate since 1990, and it's going to get even worse in 2016. We're calling for about 6.2%, and so a lot of this is necessary rebalancing. So if you look at the Chinese economy, about half of all growth comes from and in most developed economies or mature economies, fixed investment only accounts for about 20% of GDP, and so really the way they were growing was unsustainable, and so that rebalancing is necessary, but there is certainly going to be some near-term pain. Just a quick comment on the recent stock market turmoil over there. We think that it will have limited effects on the economy. The stock market there is not nearly as tied to the economy in terms of how companies are financed, but also in terms of household wealth. And so we think there will be a fairly limited impact from that. So when we look at overall global growth using industrial production as a proxy and looking at the U.S., the question becomes kind of can the U.S. go it alone if we are seeing such some trouble in the world economy? And we think that generally it can. If you look at this chart, what you have is, if you look at the blue line, which is the U.S. GDP, that tends to start decreasing before you see trouble in the global economy. So generally it's the U.S. economy that pulls the globe into a slowdown. And we saw that back in 2001. When you look at around 97, 98, when global growth did slow pretty dramatically following the East Asian financial crisis, U.S. growth didn't really budge. We continued to hum along at a pretty decent rate. So why is that, and why do we think that the U.S. economy can continue to grow even though we see a lot of areas of weakness in the global economy? Well, one is that the U.S. still remains a fairly closed economy. So if you look at the net share of exports of our economy, so netting out things that we export maybe to only re-import later, that only accounts for about 8.3% of U.S. growth. So if you compare it to some of these other countries, you can see that a lot of other places are much more dependent on what's going on around the rest of the world, and the U.S. still remains fairly insular. Think of some of the biggest areas of spending in the U.S., like healthcare. That's completely unreliant on what's going on in the rest of the world. Same thing with government spending. So again, fairly insular, and we think that the U.S. economy can continue to expand even though there is weakness overseas. So looking at fixed investment back here in the U.S., so this is one area though that is going to be weaker this year, and we've already seen it. We got another weak print in today's GDP report, and so we're only looking for investment to grow about 3%, and a lot of that has to do with the slowdown in mining that we've seen. So mining activity a few years has only accounted for about 7% of new investment, but it's accounted for 15% of the growth. So it's been it's essentially been fighting above its weight there. Now, we don't think that we'll see it go completely negative, and that's because other industries are beginning to invest more. So there's less uncertainty on the U.S. horizon, and also when you look at bank lending, that's becoming more readily available, and so that's been one factor boosting business and investment as well. And you also have pretty healthy balance sheets of businesses, so that's helping. So even though you have seen an expansion of debt in the business sector faster than what we've seen in the consumer and government area, the balance sheets remain pretty good. So if you look at corporate interest expense relative to pre-tax profits, those remain fairly low. And if you look on that right-hand side chart, so that's the share of short-term debt relative to total debt. And you can see that there's not a lot of short-term debt out there, which means that when the Fed does begin to raise rates, which we think will be later this year, companies aren't going to be as greatly impacted by that as they have in previous tightening periods where they did have a lot more short-term debt they had to roll over. So that bodes well for business investment spending over the next year and a half or so. So looking at the consumer, so this is really the one area that where we're seeing a shift in terms of the composition of GDP, and this has really become the driver of growth. So we saw in today's report, consumer spending increasing just shy of a pace, even though overall GDP increased only 2.3%. And so you can kind of see that shift, and really this has been a standout area. And while we're still not seeing numbers quite as strong as kind of the 4.5% rate that we saw back in the past expansion, we think that this is more sustainable. And a big part of that is the healthier balance sheets of households. So you've seen overall debt levels relative to income come down pretty substantially over the past 10 years or so, back to about 2003 levels. But what's even more impressive is if you look at debt service. So here we have the financial obligations ratio, which also includes things like leases for your car, or if you rent an apartment, it treats it the same way as your monthly mortgage payment. And you can see that that's fallen much more dramatically. So consumers actually have a lot more wiggle room in their monthly budget in terms of that isn't being devoted to debt payments. And a big factor there in that bigger drop in the financial obligations ratio has been those lower interest rates. So with the stronger household balance sheets, we are seeing a rebound in consumer credit. So early on in the expansion, it was primarily driven by autos and student loans, but we're starting to see a little bit of a rebound in revolving credit, and that's been helped by some of the lowest credit card delinquencies on record. And so that should be good for some more discretionary spending out there. And of course, a big story for this year has been the drop in oil prices. And while it has hurt the investment side of the U.S. economy, it has been good for household spending. So you can see from this chart that really it's the middle class who's going to benefit the most from this in terms of their outlays, what's actually devoted to gasoline. And so that's going to be about $700 extra dollars in household pocketbooks. Now, they haven't been in a great rush to spend it. We've seen the savings rate tick up a little bit. But we think that as they see that these lower prices are going to stick around for a while, we do think that that's a big positive for consumer spending over the remainder of the year. And we're already starting to see a recent acceleration in consumer spending. It's taken a little bit of time for those savings to filter through, but we are starting to see some pickup there. Now, of course, for most households, what matters most in their spending decisions is what's going on in the labor market, and so there we continue to see some good improvement. So we're adding jobs over 200,000 a month. So this is a bit of a deceleration from what we saw in 2014. But when you look at the labor force growth, which is only growing about 1%, whereas jobs are growing about 2%. We're still creating plenty of jobs to continue to bring down the unemployment rate. So you can see that whether you take a broader view of unemployment, so the U6 measure includes people who are working part-time but want to work full-time, and it also includes folks who have been who aren't in the labor market now but are ready for a job if it were available and they've searched in the past year. That continues to come down pretty quickly. But you can see from the headline rate, too, we're actually getting pretty close to what the Fed considers full employment. And this is usually where you start to see some wage pressures. And indeed, we are starting to see that. So there are a couple of different measures of wage growth out there. One that gets a lot of airtime, but economists don't like quite as much, is the average hourly earnings that comes out in the monthly payroll report. This doesn't adjust for the composition of jobs in the economy. But if you look at the ECI, so this controls and it looks at what employers are having to pay for a certain position in a certain industry. You can see that we've seen an acceleration in wage growth over the past year. So before we weren't seeing really much except for kind of cost of living adjustments, just a little below 2%. But we're finally starting to see a pickup there and some real wage gains for workers. Now, the housing market is also an area that's doing better this year. So we kind of had a false start back around 2012, but this time around we're pulling more traditional buyers back into the market. It's less investor-based, and we've seen home sales increase nicely since the start of the year, both existing and new home sales, and we think there's room for further improvement ahead. So even though interest rates are expected to rise later this year, they still remain fairly low, and with the stronger job and income growth, that should continue to support that should continue to support the housing market. And then we're also seeing some positive signs in household formation. So long-term rate of household formation is about 1.2 million. So you can see we were well below that for about 7 or 8 years, and we're finally starting to see those young adults moving out of their mom and dads and into their own place. And so that's come with some stronger income growth there as well, particularly among young workers. But of course, when most people move out for the first time, you tend to move into an apartment. So we're seeing a lot of strength in the apartment market, where you have a lot more building than we historically see as a share of total new construction. And so this is going to be important for when we look at housing's contribution to overall growth economy. And you think of an apartment, and it requires a lot less labor, a lot less materials, and a lot less stuff to once you build it to put in it. And so kind of the multiplier effect of housing looks to have downshifted again. And while we're still not back to what we would consider normal levels, the multifamily market has more than recovered. Okay, so turning to inflation, so this has really been kind of the major impediment to, I think, the Fed raising rates. So the labor market, as we saw from the unemployment rate chart, it is pretty much right where the Fed considers full employment. But inflation has been running so low that I don't think the Fed is in much of a hurry to raise rates. But we have seen a pickup more recently. So these are year-over-year numbers. But if you look at what the rate of inflation over the past 3 months, you've seen core inflation picking up to about a 1.7% annualized rate. So still lower than what the Fed would like to see. But those core numbers are becoming increasingly important with the drop in oil that we've seen over the past year and even over the past month. Now, what's interesting in terms of what's going to give the Fed confidence that inflation can indeed return to 2%, because they've made it clear that they don't need to see inflation at 2% before they begin raising rates, but they need to be confident it will get there in the next year or two, is if you break down core goods and services. I think this is pretty telling of demand in the economy. So really, even the weakness in core has primarily stemmed from what's been going on in the prices for goods, which again is a more global market. It is influenced more by the strength of the dollar. But if you look at core services, that inflation there remains pretty steady, and it doesn't suggest any real weakening in demand. So I think that will bode well for future price gains. Okay, so when we look at the possible path for a Fed funds rate and tightening there, you do have the vast majority of FOMC members still looking to raise rates later this year. There's a lot of discussion between September and December. Our base case is a September rate move. We think they've been keeping the door open for that move. And a couple more employment reports and a couple more inflation reports that they're looking a lot at the cumulative progress that has been made over the past few years. So even though inflation is a little bit low, it does tend to be a lagging indicator, and monetary policy cannot turn on a dime. So they need to be forward-looking about that. So we're anticipating 2 rate increases later this year. So that would bring the Fed funds rate between 50 and 75 basis points. But generally speaking, we think that it's going to be a much more modest pace of interest rate increases than what we've seen in prior cycles. So this is for a number of reasons. So partly it's from the fact that, as mentioned earlier, global growth remains relatively weak, and you actually have a lot of central banks around the world actually increasing monetary policy accommodation. So this is having effects on the strength of the dollar. So in some ways, the Fed doesn't need to increase to moderate economic growth, or at least kind of normalize policy, because you have the dollar being somewhat restrictive. The other thing is, we talked a little bit about potential growth, and given the slower rate of productivity and the slower rate of labor force growth, your equilibrium rate of the Fed funds rate, or really where the funds rate would be where it's neither choking off growth or it's neither stimulative, has likely fallen. And so that's part of the reason we're projecting a more modest increase in the pace of rate increases. But I think one of the big factors, too, is that you do have folks on the FOMC, and including Chair Yellen seems to be coming around to this view, that the sooner you start, the more gradual you can go. So you can kind of wait and see. You're not necessarily getting behind the curve. And so we think that's going to play into their thinking as well. So this is just a summary of some of the main themes that I talked about and what's behind some of that. And I think we can go ahead and open it up to questions, James.
Great, Sarah. That was great. Very detailed, very informative. And yes, right now we are opening up the floor to questions. I know that there was a lot of information that you got to digest, but you have a question box. Please type in your questions now and get those to Sarah. Now, the one question I do have is when you were looking at the fact that we are now seeing wage rates beginning to some upward pressure on that, how much does that have to do with the economy improving, also to lower labor participation?
So I think the pickup in wage growth does reflect a tightening labor market, and part of the reason why it's tightened, I think, faster than a lot of folks have anticipated, including the Fed, is we have seen that lower labor force participation. And really, even though the economy's been expanding since 2009, you've seen the labor force participation rate continue to decline. It's actually out more recently, but you haven't seen that cyclical turnaround. And so, there is a concern that you have lost some folks perhaps permanently. And so then, of course, your pool of available labor is going to be smaller, and so that would increase in wage pressures as well. And it's really interesting. Some of the areas we've actually seen some of the strongest wage growth over the past year has been for unskilled jobs, like leisure and hospitality, like retail. And that was even before we saw the minimum wage increases at the beginning of the year. So I don't really think that's playing a big part of it. But it does seem like some genuine signs of tightening in the labor market.
And has any of there's been so much in the news as well about the reshoring of manufacturing jobs, and has that shown up as a positive or even a drag on the economy, these jobs coming back, or these industries relocating back to the U.S.?
Well, you have seen an increase in manufacturing employment, but if you went back and looked at a time series of it, yes, even the past couple of years, but it's still relatively low. Generally we've seen manufacturing employment decline since the 1970s. So even though we're seeing some improvement now, it still kind of pales in comparison to the jobs we lost due to that offshoring. But I think, as you are probably well aware, that these tend to be more advanced manufacturing jobs, and you're not necessarily employing the same amount of people to run a plant nowadays that you would have 20 years ago when it went overseas. So you have a lot more technology in the process, and so from an employment perspective, it's a lot less impactful than I think a lot of times the media or politicians make it out to be. It's great for GDP, but a little bit more limited in terms of the employment growth, although they do tend to be some better paying and high-skilled manufacturing jobs, which is, of course, good for the economy.
Well, Sarah, I really want to thank you for taking time to speak with us today. We are at the 1 o'clock, and I just want to be mindful of time for our participants. All of you that have attended, I want to thank you for attending our presentation today. You will see that in the handouts there is this presentation so that you can look at your leisure, as well as Sarah's bio. We are certainly open to any questions that you may have, and if you want to contact Sarah as well, more than happy to do that as well. With that being said, I'm James Kemper, WH Meaner & Associates. Want to thank everybody today, and talk to you real soon.